The most dangerous number in investing is not always the one that looks the highest. Sometimes it is the one that looks reassuringly low. That is one of the first things I would want an investor to understand. A stock can look cheap and be expensive. A stock can look expensive and be cheap. The market does not hand out bargains according to how comfortable a single ratio makes you feel. It hands them out according to the relationship between price, quality, growth, cash generation, and the future earning power of the business. People want investing to be simpler than it is. They want one number, one shortcut, one little key that opens every lock. I understand that desire. I do not trust it. I have spent my life looking at businesses, not tickers. And one lesson keeps returning in different clothes. A stock is not cheap because the price looks low. A stock is cheap only if the price is low relative to what the business can become. That sounds simple. It is not simple at all. The reason it is not simple is that the future matters, and the future never introduces itself with complete honesty. That is why so many investors get trapped. They see a low multiple and feel safe. Or they see a high multiple and feel prudent by staying away. But the low multiple may belong to a tired business whose best years are behind it. And the high multiple may belong to a business that is still early in a long runway of economic value creation. If you do not understand that distinction, you will keep doing something I have watched people do for decades. You will buy what merely looks cheap, and you will avoid what only appears expensive. That is a miserable way to invest, because it gives the illusion of discipline while quietly producing mediocrity. I do not want illusion, I want judgment. And judgment begins when you stop asking only what is the multiple and start asking what is the business actually capable of doing over time. Now, I am not a man who worships formulas. I never have been. A formula is a servant. It is not a substitute for thought, but a good formula can save you from a stupid first impression that makes it useful. The first formula almost everyone learns is the price-to-earnings ratio. It is famous because it is easy. Take the stock price, divide it by the earnings per share. If the stock trades at $30 and the company earns $3 a share, the PE ratio is 10. That means you are paying $10 for each dollar of annual earnings. Perfectly simple. And because it is simple, people immediately start misusing it. They say a low PE means the stock is cheap. Sometimes it does. Sometimes it means the market believes the business is weak, shrinking, cyclical, poorly managed, badly positioned, over-leveraged, or simply not worth much more than its current output. The number by itself does not tell you which world you are looking at. That is why I am always cautious when someone hands me a low PE ratio, as if he has already done the hard work. He is not. He has only identified a surface condition. A low PE is an invitation to ask a better question. It is not the answer. Let me put it another way. If one business trades at 10 times earnings and another trades at 30 times earnings, many investors feel clever for preferring the 10. But what if the business at 10 times earnings is hardly growing at all, faces structural pressure, and needs substantial capital just to stay in place? And what if the business at 30 times earnings is compounding profits at a rapid rate, has a wide moat, throws off cash, and is early in a very long expansion? Which one is actually cheaper? You cannot know from PE alone. That is the limitation. A company is not a static object. It is a moving economic organism. Its value depends not only on what it earned last year, but on what those earnings can become. Once you understand that, you begin to see why a single valuation number can be so deceptive. The PE ratio gives you the price relative to current earnings. Good, that is useful. But if current earnings are only the first small layer of a much larger future, then the ratio can make a growing business look expensive when it is actually reasonably priced. And if current earnings are the best the business will ever look before conditions deteriorate, then the ratio can make a weakening business look cheap when it is actually a trap. This is why people who think valuation begins and ends with PE spend a lot of time feeling conservative and a lot of years making unimpressive returns. They are looking at the current frame and mistaking it for the whole film. I do not want to do that. I want the frame and the direction of the film that brings me to growth. Growth is one of the most abused words in finance because people hear it and start behaving stupidly. They think all growth is equally valuable. It is not. Growth bought with constant dilution, weak economics, reckless capital needs, or a total absence of durable advantage is not the same as growth built on a genuine competitive edge. But real growth matters a great deal. If earnings can rise significantly over time, then paying a richer current multiple may be entirely reasonable. That is the piece a plain PE ratio cannot absorb very well. The market has known this for a long time. Thoughtful investors have known it even longer. That is why the PEG ratio became so important to many people who wanted a more honest first test. The idea is almost embarrassingly simple. Take the PE ratio and divide it by the company's earnings growth rate. That gives you a new lens. If a business has a PE of 30 and is growing earnings at 30% a year, its PEG ratio is 1. If another business has a P of 10 but is only growing at 5% a year, its PEG ratio is 2. Now something interesting happens. The stock that looked cheaper by PE alone may no longer look cheaper once growth enters the room. That is the whole genius of the PEG idea. It reminds the investor that price and growth belong in the same conversation. They do not live in separate houses. I have always liked any tool that forces two truths to meet each other. Honestly, PE asks what you are paying for today's earnings. PEG asks whether the rate of growth changes how that price should be judged. That is a smarter question, and smarter questions usually produce better decisions than louder opinions. The crowd often gets stuck in one of two foolish camps. One camp says never pay up for growth. The other says growth justifies almost anything. Both camps are lazy. A sensible investor knows the issue is not whether growth matters. Of course it matters. The issue is what kind of growth, at what price, with what durability, under what capital structure, and with what probability of persistence. That is a much more adult conversation. Suppose you have two businesses. One is trading at 15 times earnings and growing at 5%. Another is trading at 30 times earnings and growing at 25%. The first one looks safer to a certain kind of investor because 15 feels more respectable than 30. But respectable is not the same thing as attractive. If the first business barely grows, then 15 times earnings may actually be a full price for a sleepy operation with little runway. If the second business can compound at a high rate for years, then 30 times earnings may not be aggressive at all. In fact, it might be a bargain relative to what the business becomes. That is why the PEG ratio is useful. It pulls the investor out of the lazy comfort of current multiple worship and asks him to think dynamically. The stock does not just have a price. It has a price relative to a growth engine. Now, you must be careful here. The market is full of people who make up heroic growth projections and then divide one hopeful number into another hopeful number until they feel brave. That is not analysis. That is wishful thinking using arithmetic as camouflage. The growth rate you use matters. It should be grounded, not fantasized. It should reflect business reality, not your need for the stock to be a bargain. There is no formula in the world that can protect an investor from dishonest inputs. A fair equation with absurd assumptions is still absurd. That is why I say formulas are servants. They are not masters. They help you organize thought. They do not replace it. Still, when used with sobriety, the PEG ratio teaches one of the great truths of valuation. A business growing much faster may deserve a higher multiple, and a business growing very slowly may deserve a lower one than naive investors assume. That alone can save people from buying a lot of cheap-looking mediocrity. But even PEG leaves something out. That is where the conversation gets richer, because a business can reward owners in more than one way. It can grow and it can pay. Too many investors act as though all return is deferred into the future. That is not true. A business that sends cash back to owners through dividends is giving you part of the return. Now, not just later. That matters. It matters mathematically. It matters psychologically. And it matters especially in a world where people too often pretend that current cash return has no value compared with distant hopes. I have never thought that was intelligent. Cash in hand is not everything. It is also not nothing. A business that grows earnings and pays a meaningful dividend is different from a business that grows at the same rate but pays nothing. The owner of the first is receiving current economic participation while still benefiting from future growth. That deserves recognition. And that is exactly why the dividend-adjusted version of PEG becomes so interesting. Some investors call it PEGY. The idea is simple. Take the PE ratio and divide it by the sum of the earnings growth rate and the dividend yield. Now, you are not just asking whether growth justifies the price. You are asking whether growth plus current cash return justifies the price. That is a much fuller picture. If a business has a PE of 30, grows earnings at 30%, and pays a 3% dividend, the dividend-adjusted ratio becomes more attractive than the plain PEG would suggest. Why? Because the owner is not just waiting for growth, he is being paid while he waits. That is worth something. In fact, it is worth more than many people realize. One of the quiet strengths of dividends is that they turn the ownership experience from pure hope into partial evidence. A business can tell you a fine story about its future. A dividend tells you at least some current cash is real enough to share. That matters. Now, I do not want you to become childish about this and think any dividend instantly makes a stock wonderful. A bad business with a dividend is still a bad business. A dividend can be unsafe. A payout can be financed stupidly. A company can over-distribute and hurt itself. All of that is true. But a healthy dividend layered on top of real growth changes valuation in a very sensible way. It means part of the shareholder return is no longer deferred. That is why a business with the same PE and same growth as another business may still deserve a better adjusted valuation because it pays owners meaningfully along the way. This is one of the reasons certain types of companies become such durable compounding machines. They grow steadily, they earn real money, they send some of it back. They are not asking you to believe in a dazzling faraway future while giving you nothing tangible. In the meantime, that kind of structure deserves respect. Let me step back and tell you how I would use these ideas in the real world, because the ratios are only valuable if they improve the order in which you think. First, I would use PE as a baseline, not a verdict. A baseline. It tells me what the market is asking me to pay for current earnings. That is the first question. Fair enough. Second, I would ask whether growth changes the interpretation of that price. This is where PEG enters. If the company is genuinely capable of growing earnings at a solid rate with some durability, then the headline PE may not mean what a superficial reading suggests. Third, I would ask whether the business also pays me while it compounds. If it does, then the dividend-adjusted framework becomes more relevant. A strong dividend paired with healthy growth can make a stock more attractive than a plain P or plain PEG would imply. So far, that sounds almost mechanical. But now comes the part that separates investing from calculator worship. You must ask whether the business itself deserves the confidence required by those numbers. This is where many people go wrong. They find a good-looking ratio and stop thinking, I have no interest in that sort of laziness. A ratio does not create a moat. A ratio does not improve management. A ratio does not strengthen the balance sheet. A ratio does not protect margins when competition intensifies. A ratio does not tell you whether growth came from real operating strength or accounting softness or a lucky temporary tailwind. You still must understand the business. In fact, the better the ratio looks, the more suspicious I become until the business quality confirms it. Because the world is full of things that look cheap for reasons that are not hidden very deeply. Sometimes the market has simply identified weakness before you did. I want to know what the company sells, why customers buy it, whether those customers are likely to keep buying it, whether the company needs heavy capital spending just to stand still, whether margins are durable, whether debt is manageable, whether management is honest and rational with capital, whether the industry structure allows good returns or invites a race to the bottom. Those are adult questions. The ratios help point me toward them. They do not exempt me from asking them. I often think investors get into trouble because they want valuation to function like a vending machine. Put in a number, get out a decision. Life is not that tidy. The ratio can tell you that something deserves a closer look. It cannot tell you whether the future will honor the assumptions embedded in the look. That is your job. And it is why judgment remains scarce even in a world full of free data. Scarcity in markets does not always come from information. Very often it comes from interpretation. Now, let me tell you where these tools become especially dangerous. Fast-growing stories. The market loves stories because stories flatter imagination. A company comes along with exciting growth, a thrilling market opportunity, perhaps some charismatic leadership, and investors begin acting as if numbers no longer matter. That is one kind of mistake. The opposite mistake is made by investors who are so frightened of paying up for growth that they refuse to buy excellent businesses at sensible prices because the PE looks rich compared with old industrial companies that have no comparable runway. Both errors come from refusing to join price and future economics in the same frame. The ratios we are discussing can help solve that if used honestly. A rich PE can be reasonable if growth is real, durable, and backed by a strong business model. A low PE can be foolish if growth is absent, cash returns are weak, and the business is slowly decaying. I have seen people buy the second category while congratulating themselves for discipline. That is painful to watch. They think they are value investors. Often they are merely buying neglected mediocrity. Real value investing is not buying low multiples. It is buying businesses for less than they are worth. Those are different things. Worth is not a synonym for cheap looking. Worth includes the future. It includes the quality of the earnings. It includes the durability of the economics. It includes the ability to allocate capital intelligently. And yes, it includes whether you are getting paid while you wait. That is why I find the dividend-adjusted view so useful. It does not make dividends into religion. It simply acknowledges a truth. $1 of current return has value. If two companies are equally expensive on PE and equally strong on growth, but one pays a healthy dividend and the other pays nothing, the shareholder experience is not identical. The business paying you is giving you one more avenue of return. That should count. Now, you must still ask whether the dividend is safe. There is no point admiring a yield that comes from a business straining to maintain appearances. I prefer cash return that arises from strength, not from denial. A good dividend comes from a business that earns well, needs only a sensible portion of those earnings for reinvestment, and can still return capital without injuring the franchise. That sort of dividend is wonderful. It signals maturity, discipline, and economic substance. A forced dividend from a weak balance sheet is not wonderful. It is often a warning. You see how quickly judgment returns. That is what I mean when I say the formula is a servant. The servant can help you organize a house. He cannot decide what kind of life belongs inside it. I also want to say something about expectations, because ratios can become very seductive when people forget the role of uncertainty. The PEG ratio depends on growth. The dividend-adjusted version depends on growth plus dividend yield. Fine. But growth is not guaranteed. That is where humility enters. A company growing at 20% today may grow at 8% 2 years from now. A company with a wonderful product may discover that competitors are not as stupid as investors hoped. A management team may allocate capital poorly. A market opportunity may prove smaller than the early stories suggested. This is why I would never treat these ratios as automatic buy signals. I treat them as prompts for thought. They are questions, not commands. A plain PE asks, what am I paying for the current earnings stream? A PEG asks, does growth justify some part of that price? A dividend-adjusted PEG asks, does growth plus current cash return make the valuation more attractive than it appears at first glance? After that, the real work begins. How durable are the earnings? How believable is the growth? How safe is the dividend? How strong is the competitive position? How cyclical is the business? How much debt sits underneath the pleasant surface? How capital-intensive is the enterprise? What happens if the economy weakens? What happens if the market no longer grants the same multiple? Those questions matter because valuation is never only about the ratio. It is about how fragile the assumptions behind the ratio are. A strong business can withstand moderate disappointment and still work out well for the owner. A weak business priced for perfection can destroy capital with only a little bad news. I have always preferred situations where the downside assumptions are survivable. That is not because I dislike upside. It is because I respect permanence. The first rule of compounding is not to be brilliant. It is not to be foolish in ways that permanently remove capital from the machine. And a great many foolish decisions begin with elegant numbers attached to weak businesses. So let me give you the actual sequence I would want a serious investor to follow. First, find out what the business does and whether you can explain it simply. If you cannot explain it, do not try to value it with decimal places. Second, look at current earnings and the PE ratio. Get the baseline. Third, study the growth rate, not the fantasy growth rate, the real one. What has the business done? What can it plausibly continue doing? Fourth, check whether the company pays a dividend and whether that dividend is economically well supported. Fifth, evaluate the balance sheet, the moat, the capital allocation, and the quality of management. Only then do the ratios become genuinely helpful. At that point, they are not floating in space. They are attached to a real business with a real context. That is how they should be used. If you reverse the order and begin with the ratio, you can fool yourself very efficiently. And people love efficient self-deception in markets. It lets them feel analytical without actually increasing the quality of their thought. I want to avoid that. Let me show you why this matters so much. With a simple contrast, imagine one company trading at a P of 12. It looks cheap. Growth is 3%. Dividend is 1%. Debt is substantial. Margins are under pressure. The industry is mature and heavily competitive. Management has not been particularly gifted with capital allocation. Now, imagine another company trading at a P of 24. At first glance, it looks expensive relative to the first. But earnings are growing at 18%. Dividend yield is 2%. The balance sheet is clean. Returns on capital are strong. The company has pricing power. Customers are sticky. Management is rational. Which one is truly more attractive? A person staring at PE alone may choose the 12 and feel prudent. A person thinking across price, growth, dividend, and business quality may prefer the 24 without apology. And in many cases, he would be right. The market does not reward the illusion of cheapness forever. It rewards economic reality over time. That is what Peter Lynch and other thoughtful investors understood so well. They were not hypnotized by the obvious number. They were asking whether the growth in economics made the visible number misleading. That is the whole trick. And it is a very useful trick because the market loves to encourage lazy classifications. Cheap, expensive, growth value, income, tech, defensive, those labels are too broad to guide capital properly. I care much more about the price relative to the economic future. If a business is growing well, paying me sensibly, and is supported by solid economics, I will not let a superficially high PE frighten me automatically. If a business is stagnant, capital hungry, and burdened by strategic weakness, I will not let a low PE seduce me automatically. That is the discipline. Now, there is one more thing I want to say because it matters enormously for real-world investors. You do not need to calculate 50 ratios on 500 stocks to use this framework. Well, in fact, too much screening often becomes a sophisticated form of avoidance. People keep scanning because scanning feels like progress. Sometimes real progress begins when you stop scanning and start understanding. A handful of understandable businesses studied deeply is worth more than a giant spreadsheet of symbols you will never truly know. The market tempts people into breadth because breadth creates the feeling of productivity. I prefer depth. Depth teaches you what normal looks like for a business, which makes abnormality easier to spot. Depth also makes your ratios more useful because you know what kind of company they are describing. A PEG ratio of 1 does not mean the same thing in every industry, every capital structure, every cycle, or every competitive environment. Context matters, and context belongs to the investor willing to look beneath the screen. That is why I have always told people to treat stock ownership as business ownership, not poetically. Literally, if you were buying the whole business, would you really decide based on one little number? Of course not. You would ask what it earns, how fast it can grow, how much cash comes back to owners, how much competition it faces, what capital it requires, whether the managers are trustworthy, whether customers are loyal, and whether the asking price is justified by all of the above. That is exactly what these ratios are trying to help you think through. They are not magic lenses. They are prompts towards sanity. Use them that way and they can save you from both vanity and laziness. Ignore their limits and they become one more way to sound smart while buying badly. So if I had to reduce this whole discussion to a practical framework, it would sound like this. Start with PE, but do not stop there. PE tells you the price of current earnings. Then move to PEG and ask whether growth changes the fairness of that price. Then move to the dividend-adjusted view and ask whether current cash return improves the value proposition further. After that, return to the business itself. Always return to the business itself. Because a wonderful formula tied to a weak business will, and an incomplete formula tied to a wonderful business may still point you toward something excellent if your judgment is good enough to see beyond the surface. That is what matters. Not the elegance of the screen, the quality of the thought. The purpose of these tools is not to make investing mechanical. It is to make your first impression less stupid. That is already a very large advantage in a world where many flee from temporary ugliness or hide behind a low multiple as if arithmetic alone could protect them. Arithmetic helps, judgment protects. And judgment becomes much better when you remember that a stock is not just a price. It is a business, a growth path, a cash machine or lack thereof, a management team, a competitive position, and a claim on a future that must be examined. Honestly do that, and the ratios become useful. Forget that, and the ratios become toys. I have no use for toys where real capital is concerned. I want tools. And these can be very good tools so long as you keep them in their place.